Evergreen Group Limited, Client 3, amounts exclude VAT unless indicated otherwise. You are currently busy with the audit of the Evergreen Group Limited, a group of companies with head office in Kimberley, which invests in renewable energy in the form of solar, wind, hydro and biomass energy plants. These plants typically have useful and economic lives of 20 years with minimal end values. The group sources good energy investments products in South Africa and has a long-term strategy to expand to the rest of Africa. Each project has a separate management team, typically within a standalone subsidiary, and the key management of the Evergreen Group occupy seats on the board of the subsidiary companies. The group is actively pursuing its investment strategy and typically looks for projects with long-term value, characterized by good contracts with government and strong management teams who can provide excellent returns from the project. Goodwill or bargain purchase gains typically arise from the transactions. Right, now when we look at this, I will assume the scenario to be a parent and then there is a few subsidiaries. Now guys, please don't freak out and think that this isn't a group question. Guys, at this point of time, if there is small little bits and pieces of groups in FAC 4861 or 3, you should be comfortable with us. They're not going to ask you detailed questions, but you must still be able to apply some of the knowledge and understand the scenarios. The audit has progressed well. Sorry guys, last sentence. All companies in the group state compliance with international financial reporting standards and are VAT vendors. The audit has progressed well and the team is now auditing the group financial statements. The third-year trainee on the audit has prepared the working paper below, which relates to the consolidated property, plant and equipment of the group. External Audit Working Paper PPE 101. Right, we are able to identify that this is Evergreen Group Limited, prepared by third-year trainee, reviewed by the audit senior, which will be you. Subject consolidated PPE reconciliation. Our year end 31 December 20.18. Date compiled 2nd of February. Review the 5th of February. And our document number PPE 101. Objective. The objective of this working paper is to review the consolidated property, plant and equipment reconciliation. Right, now let's have a look at this. We are able to identify that there is land, buildings and machinery. They indicate as restated and vehicles. Now immediately guys, when we look at this, we know we need to apply our principles of IAS 16 and then restated our principles of IAS 8. Okay, so when we look at the headings, we have opening balance, additions. Additions through business combinations, our IFRS 3 principles, transfers, depreciation, we need to identify the depreciation methods, disposals, items were sold, impairments, we need to apply IAS 36, and a closing balance. Notes following the audit work. Note 1 relates to land. They indicate to us the accounting policy of land was agreed to the prior year's working papers. Land is revalued every second year at the end of the year with revaluations recognized in profit or loss. Right guys, question mark. We know now that this is based on our revaluation model. Therefore, we know our revaluation surpluses will be recognized in our OCI. The last revaluation was done on 31st of December 2017. Discussions with experts confirmed that there has been no significant changes in the value of land and the cost to sell is negligible. Okay, so for our level 2 students, maybe something about IFRS 13 fair values. We don't know at this point of time. Note 2 relates to our buildings. The accounting policy of buildings was agreed to the prior year's working papers, which indicated that buildings are carried on the cost model. Note 3. The accounting policy of machinery was agreed to the prior year's working papers, which indicated that machinery is carried on the cost model. Compare the opening balance of machinery to the prior year's working papers, the closing balance, and noted a restatement. The client explained that the restatement relates to the change in depreciation method of the current year. Right, now we need to identify that this is change in estimate. Therefore, if this is a change in estimate according to IAS 8, we need to adjust this in our current year and in our future periods. Now, they have corrected the opening balance. Therefore, guys, this is incorrect because they need to adjust this in the current year and future periods. Now, go back and adjust an opening balance. The client adjusts the opening balance to what the balance should have been had the new depreciation method been applied from the initial recognition date. The depreciation method changed from the straight line method to a method based on sales of the output from the machinery. Management believes that the sales of the output base reflects the pattern in which the machinery's future economic benefits are expected to be consumed by the entity within the context of South Africa's current inflation environment. Management has also decided to keep its selling prices fixed and absorb the 1% increase in the VAT rate in the short term. Okay, so guys, now just quickly think about this. Your depreciation rate should reflect how that asset is used, consumed, the pattern, how that asset is used, right? Now, when you think about sales, our sales will fluctuate. We have variables such as our units and our price. Now, they indicate to us that included in that price is that 1% in terms of the VAT change, right? Now, do you think if this is my machine, imagine that this purple, let's say purple, this is my machine. Do you think really, guys, that the sales value will indicate or reflect how this asset is actually used? No, guys, it doesn't make sense. Why will I depreciate my asset based on a sales number? I would rather depreciate the use of that asset either based on the years or based on our production. How many units that asset can generate production. Right, okay. Note 4. Let's have a look. Note 4 relates to transfers of machinery. Note 4555. The client decided to rent some machinery to lessees in terms of operating leases. IFRS 16, remember? Accordingly, some of the machinery was transferred to inventory. Guys, think about your definition of IAS 2. Is this inventory? While the remainder was transferred to investment property. Really? Is this investment property? Investment property will be land or buildings, not a machine. Since date of transfer, no depreciation was recognized on the machinery transfer. Note 5. Now let's have a look. Where's note 5? Note 5 relates to our impairment. This pink section here, guys. IAS 36, impairments. Note 5. The client has one cash generating unit, being the group. Whoa, let's just stop right there. So we have identified that we have a parent and most probably we have a few subsidiaries. Now what they are indicating here is that this group will be our CGU, question mark. Let's just quickly have a look at the definition of a CGU. In terms of IAS 36, a cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. Therefore, guys, when you look at this, I will assume the separate entities will be CGUs. They should be able to generate cash flow on its own. Now, why? When you look at the introduction section, they have indicated quite a few things here, that each project has a separate management team. Therefore, guys, a project can be a subsidiary. Doesn't have to be, but typically within a standalone subsidiary. And the key management of Evergreen Group occupies seats on the board of the subsidiary. Right, guys, when you look at this, it appears that there is more than one CGU. Right. Okay, so then the indicator as goodwill arose from the various business combinations, and accordingly goodwill is tested annually for impairment with no goodwill impaired previously necessary. This is in terms of IAS 36. We need to test goodwill annually for impairment. The recoverable amount is based on the value in use, this being the higher value. This was compared to the carrying amount of the group cash generating unit, and the total impairment loss recognized in profit or loss amounted to 385,000 in the current financial year. There were no other impairment losses recognized. Right, now when we look at this 385,000 and we refer to our recon, should we add the 105, 205, 75? This will be 385,000. Right, guys? Just quickly now that we look at this, if our land is based on our revaluation model, if there is any impairment on our land, we know that this should be in our OCI, right? That they need to allocate the impairment based on the carrying amounts of the assets, which also doesn't actually look, or it doesn't look as if this is in land. Okay, now let's just move on. Note number 6, delivery vehicle. The indicator us when we look at the notes, note number 6, delivery vehicle, this 228 disposals. A delivery vehicle was involved in an accident and was written off by the insurance company. The carrying amount of the vehicle on the date of the accident amounted to 218,000, and the insurance company paid out 228,000. Now, do you see, guys, this 228,000 agrees with the recon. Now, this doesn't make sense. Why not? Because the vehicle was written off. Therefore, we first had to take out this vehicle, the remaining carrying amount, and then we are able to recognize this as income in our profit or loss. We can't include the amount received, the income, in our PPE recon. Right, let's move on. Note 7. Now, when we look at the information provided, guys, in the recon, note 7, this relates to the additions through business combinations. I'm not going to highlight the 7. I think you're not going to see this if I use purple. Now, these are the provisional amounts for the business combination. The client concluded a business combination on 30 November 2018 and elected to present and disclose provisional amounts. The purchase price allocation was finalized on 20 January 2018. Okay, so if we think about our timeline, when you look at the timeline on the right-hand side, now remember, guys, this is your reading time. Therefore, if you do have time in your reading time, look at a timeline. If you're running out of time, stop, move on, please. I know I tend to dig in too deep during my reading time, but this is the only way that I'm able to identify the scenario. Remember, at this point of time, I don't know the requirement, but I'm able to identify errors and I am able to identify the links to the applicable standards. Now, when I look at a timeline, my year end is December. Now, they have incorporated, or they have purchased this IFRS 3 business combination 30 November, and they have finalized this in January. Therefore, when we look at this, our audit date is in February. Therefore, we will have to apply our IAS 10 principle. Why? Because we cannot use the provisional amounts if we have the final amounts within this period. This is an adjusting event and we need to adjust the figures, right? Okay, note number 8. Now let's have a look at note number 8 in terms of our recon. This is additions, note 8. Land and machinery. During the current financial year, the group purchased a land and erected wind turbines to establish a wind farm. The following costs were incurred in the project. Administration and general overheads incurred before purchase of the land, 188,000. Cost of the land, 125,000. Relocation costs paid to relocate the community that was previously occupying the land, 350,000. Cost of the machinery, group of engineers that directly managed the installation. Training costs amounts to a total of 5,088,000. Land value of 125,000 and machinery value of 38,38,000. Now they have capitalized this. Now guys, the question, can we capitalize this in terms of IFRS 16? Right, now please refer to the requirement sections. Now, the first opportunity that you get, guys, you need to allocate your minutes to each section. Right, when you look at section A, divided into 1 and 2 parts. Therefore, part 1, 20 marks, 30 minutes. Part 2, 10 marks, 15 minutes. And 1 easy mark, not free, but easy. Right. Now, when you look at the right side of your screen, you will remember that I've indicated to you at the beginning of our reading time that we need to start or assume that you start with your reading at 8 o'clock. Therefore, you need to be finished with your reading at 8:30. Therefore, in terms of part A1, you need to have this completed by 9 o'clock. In terms of part A2, you need to have this completed by 9:15, and guys, overall 9:16, 9:15. I'm going to be honest with you, when I did my questions in CTA, and even now, I prefer to include the exact time that I need to finish, because it's easier when I look at my watch to identify where I am currently, how much minutes I have left. Right, now when we look at B, in terms of B, 25 marks plus 1 mark, communication skills, 26 marks, therefore 39 minutes. And I need to have this completed by 9:55. Requirement C, 10 marks, therefore 15 minutes, and I have to complete this by 10:10. D, 3 marks, therefore 4.5 minutes. I have to complete this by 10:15. Now guys, a little bit of rounding. Okay, and then the last section, E, the total of 30 marks, therefore 45 minutes, and this should be completed by 11 o'clock. Guys, extremely important, stick to the time allocated. You will identify in the solution that there is quite a lot of easy marks, and then there is a little bit of difficult sections, difficult marks. Therefore, if you do not stick to the time allocated, you are going to waste easy marks. Right, then when you look at this, you will also identify there is 5% easy marks in terms of your communication skills. Not free, but easy. Right, now let's just briefly read through the requirement, briefly. And then guys, we will read through this again before we attempt each section. Remember, each section you need to attempt on a new page, please. Now the indicator as requirement A and B relates to client 1 only. Very important. Discuss the accounting treatment of the contract with Fleet Rent Limited in the statement of financial position of UberTrack Limited for the reporting period ended 31 December 2018 in terms of international financial reporting standards, and then limit your discussion to IFRS 16 leases. Assume that UberTrack early adopted IFRS 16 and IAS 12 income taxes based on the statement of financial position approach. Please discuss each item recognized separately in terms of the tax implications. That's applicable at 15%. Include all relevant calculations, round off all amounts to your nearest rand, assume all amounts are material, ignore your current tax, ignore comparative amounts. Now guys, if they indicate to us ignore current tax, Guys, you're not going to get marks if you discuss the implications of your current tax. Therefore, you need to please read this. Right. And then communication skills, 1 mark available. Total 31 marks for requirement A. Requirement B, review the financial manager of Ubertrax Limited's deferred taxation journal entries. Now, when you look at this scenario, you will identify there's 2 headings, a leases and tax. Therefore, pretty easy to identify what you need to look at. Okay, so they indicate, review the financial manager of Ubertrax Limited's deferred tax journal entries for the financial year ended 31 December 2018. Provide feedback to her in a memo, there's your format marks, that details your concerns with regard to any inaccuracies that are apparent from the information provided. Therefore, you need to focus on inaccuracies, the things that they did incorrect, not the things that they did correct. Support your feedback with reasons and brief calculations together with suggested correct treatment of any inaccuracies noted. Your discussion should not include any journal entries. Guys, please do not waste your time. Do not include journal entries. Discuss each journal separately. 1 mark communication skills. Please note, assume all amounts are material, round your amounts to your nearest rand, and your answer must comply with IFRS. Requirement C and D relates to client 2 only. Therefore, C and D, client 2 only. With reference to the above information, only disclose the profit before tax note in terms of IS 1 paragraph 101. If you're not sure, guys, open paragraph 104, sorry, not 1. To the financial statements of the financial year ended 31 December 2018 of Rockwell Consulting Limited. A total of 10 marks. Please note, you may assume that all amounts are material, round off all amounts to your nearest rand, comparative figures are not required, and your answer must comply with IFRS. D, calculate, important, the deferred tax asset or liability in terms of the leave pay accrual of Rockwell Consulting Limited for the year ended 31 December 2018. Now, guys, I know normally they indicate leave pay accrual, leave pay provision. They want you to calculate the amount. Therefore, don't spend time on, is this an accrual? Is this a provision? Oops, I can't remember. Now you start to freak out. No, just calculate the amount. That's what you've got to do. Okay. Your calculation should be based on the statement of financial position method. Indicate if this is an asset or liability. Important, guys, you need to indicate this to them. Right. And normally this will be a mark through mark. If you ended up with a deferred tax asset and you state that you are able to identify this as a deferred tax asset, right, easy mark. Okay. Requirement E relates to client 3 only. Critically review, therefore critically look at everything. Review the consolidated property, plants and equipment reconciliation provided in the working paper for apparent errors, inconsistencies and inaccuracies. Therefore, identify if there's errors, inconsistencies and inaccuracies in terms of international financial reporting standards. For each issue identified, include an explanation why it is an issue. Right, therefore you need to identify, is there an error, inconsistency, inaccuracy, and why do you say so? Communication skills, 2 marks, easy. No disclosure or comparative amounts is required, and no audit related concerns are required, guys. Therefore, you do not have to go into the fact that there might be audit related concerns. Right, now let's have a look at each section on its own.